Order up. One growth stock burrito, one ETF combo plate, extra options with hot sauce, double crypto nachos. Wait, nobody ordered the bonds? That happens every single day in investing. Everyone wants the exciting investments, the fast movers, the big headlines, the high flyers, the home runs. But sometimes the ingredient nobody talks about is the ingredient that's holding the entire meal together. Today, we're putting bonds on the menu. Good morning, ladies and gentlemen, and welcome back to another Taco Tuesday here on the Unbearably Bullish podcast. It's the official podcast of the Bull You Can't Bear, and I am your host, Donald Johns. Every Tuesday, we simplify investing one taco, one topic, and one bite at a time. Whether you're brand new to investing or have years of experience, our goal is very simple. Take the complicated financial concepts and make them easier for you to understand, because financial education, it shouldn't feel intimidating. It should feel enjoyable. Here at the Bull You Can't Bear, we believe in strong markets, stronger mindset, unlimited opportunity, and we're always looking to connect, collaborate, and monetize together. And we'd love for you to follow the herd. So grab your favorite taco and let's see what's on today's menu. Before our meal arrives, though, let's spend a minute talking about what's cooking on Wall Street. You probably have heard commentators discussing interest rates, inflation, treasury yields, Federal Reserve meetings, bond markets. Sometimes those conversations, they can sound a little complicated, but here's something interesting. Many of the biggest moves in the stock market, they actually begin inside the bond market. Understanding bonds doesn't just help you understand fixed income, it helps you better understand the entire financial system. That's why today's episode matters. Let's get to the shell, baby, because every great taco, it needs a shell. And every strong investment strategy starts with understanding the foundation. So, what exactly is a bond? I mean, imagine your neighbor wants to open a bakery, and instead of borrowing money from the bank, she asks you. She says, I need $10,000, and if you lend it to me, I will pay you 5% interest every year. Then, 5 years from now, I will return you the original $10,000. Well, congratulations, you've just purchased a bond. That's all a bond really is. It's a loan. When you buy a stock, you're becoming an owner. When you buy a bond, you're becoming a lender. That's one of the biggest differences investors should understand. Coming up, we'll explain why governments, cities, and some of the world's biggest companies all issue bonds, and while millions of investors own them. Now, let's add the meat, baby. Not all bonds are created equal. Let's talk about U.S. Treasury Bonds. Issued by the U.S. government, they're often considered among the lowest credit risk investments because they are backed by the full faith of the United States, and though all investments still possess risk. Let's move to corporate bonds. Companies borrow money to grow. They expand their operations, build factories, develop products, or they refinance their existing debt. Corporate bonds generally offer higher yields than treasury bonds because investors typically take additional credit risk. Municipal bonds issued by states, cities, counties, and municipalities, they are often used to build roads, schools, hospitals, parks, and other public infrastructure. Depending on an investor's circumstances and applicable tax laws, some municipal bonds interests may receive favorable tax treatment. Let's move on to agency bonds. They're issued by certain government-sponsored entities. They can provide another source of fixed income exposure, but carry their own unique risk and characteristics. Now let's talk about individual bonds versus bond funds. Here's a question that many investors ask. Should I own individual bonds or a bond fund? Individual bonds have a stated maturity date, and they may return principal at maturity if the issuer remains able to meet its obligations. Bond funds generally do not mature. Instead, they hold many bonds, and their share price can fluctuate over time. Neither approach is universally better. Each serves a different objective depending on an investor's goals, time horizon, and risk tolerance. Now it's time for everybody's favorite topping, the guacamole. Let's learn a few words you'll hear often. Coupon rate. This is the interest rate the bond promises to pay. Yield. Yield reflects the return an investor may receive based on the bond's current market price and other factors. Maturity. The date the issuer plans to repay the principal, assuming it fulfills the obligations. Credit rating. Independent rating agencies evaluate an issuer's credit worthiness. Generally speaking, higher credit quality usually means lower yields. Lower credit quality often requires higher yields because investors may be taking additional risk. Interest rates. Here's one of the most important concepts in investing. Bond prices and interest rates generally move in opposite directions or inverse action. Imagine you bought a bond paying 3%. Now the bonds are paying 5%. Would somebody pay full price for the older 3% bond? Probably not. That's one reason existing bond prices may decline when interest rates rise. Understanding this relationship helps explain why the bond market often reacts quickly to changes in the monetary policy. Let's add some hot sauce, baby, because every taco, it needs a little heat. Every investment has risks. Let's talk about them. Interest rate risk. When interest rates rise, existing bond prices may decline. Credit risk. Some issuers may experience financial difficulties and fail to make scheduled payments. Inflation risk. Inflation rises faster than your bonds return. Your purchasing power can decline. Reinvestment risk. When bonds mature or interest payments are received, future investments may earn different interest rates than before. Understanding these risks help investors make more informed decisions, not eliminate risk entirely. Let's move to my chef special. And tonight's chef special, let's imagine two investors. One is 30 years old and focused on primarily on long-term growth. Another is nearing retirement and places greater value on income and preservation of capital. Could bonds serve different purposes in each of their portfolios? Absolutely. There isn't a single investment that's appropriate for everyone. Financial planning is about aligning investments with goals, time horizon, liquidity needs, and individual circumstances, not finding a one-size-fits-all solution. Let's go to the secret sauce, baby. The investment with the highest potential return isn't automatically the best investment. I mean, you got to let that digest. The best investment is the one that supports your overall financial plan and risk tolerance. Let's move on to my bull bite of the week. Here's today's bull bite. Stocks represent ownership. Bonds represent lending. Understanding that one distinction will help you make sense of countless investing conversations. Let's move over to my taco challenge, baby. This week's taco challenge is simple. Open your favorite brokerage website or trusted educational resource. I want you to compare a U.S. Treasury bond, a corporate bond, a municipal bond, a bond ETF. Look at the yield, the maturity, the issuer, the credit quality. Don't rush to invest. That's a big mistake. Just become more familiar with the menu. Education is one of the most valuable investments you can make. Now, looking ahead, tomorrow on Wall Street Wednesday, we're going to break down the latest market news and explain what it could mean for investors. Thursday is Networking Thursday, where relationships become opportunities. Friday is Future Forward Friday, exploring AI innovation and the future of business. Of course, we do Success Saturday, where we study the habits that drive extraordinary achievement. Sunday is the Sunday Reset. We're helping you recharge, reflect, and prepare for the week ahead. And next Tuesday, we're 100% going to be back with another investing topic, served fresh, one bite at a time. In closing, before we close today's kitchen, remember this. Every great taco, it needs balance. The shell, the meat, the toppings, the seasoning, and every thoughtful investment strategy may include different ingredients working together toward a common objective. Some investments seek growth, some seek income, some focus on diversification. Understanding how they fit together is far more valuable than chasing the latest headline. The more you learn, the more confident you'll become, the better you're prepared to be able to make informed financial decisions. Thank you for joining me for another Taco Tuesday on the Unbearably Bullish podcast. Please visit us at The Bull You Can't Bear. Strong markets, stronger mindset, unlimited opportunity, connect, collaborate, monetize, follow the herd. I am Donald Johns, and until next time, stay curious, keep learning, and as always, stay unbearably bullish. I'm going to add the educational disclosure. We love all of you. The Unbearably Bullish podcast is provided for educational and informational purposes only. The opinions expressed are those of the host and do not constitute financial, investment, legal, tax, or professional advice. Any discussion of bonds, fixed income, securities, ETFs, mutual funds, stocks, options, or other investments are intended solely to enhance financial literacy and should not be interpreted as a recommendation to buy, sell, or hold any security. All investments involve risk, including the possible loss of principal. Bond prices generally fluctuate with changes in interest rates, and issuers may fail to meet their payment obligations. Past performance does not guarantee future results. Always conduct your own research and consult qualified financial, legal, and tax professionals before making any investment decisions. Thank you very much, everybody. Enjoy Taco Tuesday, and we love all of you. Appreciate you following.